Welcome to The Derivative by RCM Alternatives, where we dive into what makes alternative investments go, analyze the strategies of unique hedge fund managers, and chat with interesting guests from across the investment world. Hello there. Hope your summer's going well and you're enduring the heat wave across the U.S. We're back this week talking volatility and options with Gary Selz, co-founder of a unique fund of funds focused on getting option trading talent out of nooks and crannies across the prop trading world. We talk about what Gary looks for in a manager, hear stories about the prop trading and option scene in Chicago, and of course, ask the question, are they always managing the book to zero deltas? Send it. This episode is brought to you by RCM's YouTube channel, where we post this podcast, but also have some other videos in and around our work in the vol space. So head on over to YouTube, search RCM Derivative Podcast, and hit the playlist button. And you can see all our vol pods over the years in the VIX and Volatility playlist. And now, back to the show. All right, we're here with Gary. Gary, how are you?
Good. It's great to be here.
I know, and as has happened a few times on this, you're here in Chicago, but we're still doing this on Zoom.
Yeah. Traveled to Chicago and met you in person for the first time, and now I'm in my hotel room doing this podcast.
We'll figure that out one day. It's hard with all the different angles and cameras and sound. But you used to live in Chicago for a bit, right?
Yeah, I grew up in Chicago. I was here my whole life until COVID hit in 2020. And that year I moved down to Miami, and I've been down there since.
Nice. Any regrets?
Not really. I do miss the city. I miss a lot of my friends. The trader community here in Chicago is great. So it's always great to get back here, especially in the summer.
And everyone says Miami's becoming a hedge fund town, but you seeing that, or is it more like East Coast stock hedge fund type of people?
It's a little bit of both. Citadel has a big presence down in Miami, and I've met a number of people from Citadel, from Balyasny, people trading options. So I was pretty surprised, and that's been increasing over the past year. I think it's Citadel Securities business that's down there.
Yeah.
So I don't think they're a hedge fund, but yeah, it's increasing. A lot of RIAs are moving down there, Palm Beach, up that way. So all along the East Coast of Florida, up from Palm Beach down to Miami, I'd say it's transforming, but it's slowing. I would say the Great Migration, most of it has happened, but there are still people trickling in.
Yeah. And where were you in Chicago? You grew up in the suburbs, downtown?
I grew up in Skokie.
Okay.
So I went to high school there. Then I went to college at Northwestern in Evanston, and then I got a job in the city, had a prop firm.
Right. Want to dig into that prop firm a little bit.
Yeah.
So right out of school, they found you or you found them?
No, it was interesting. So I was studying electrical engineering at Northwestern, and let me tell you, that was tough.
Dodged a bullet.
Yeah, I dodged a bullet. But in my studies, they had a financial engineering course in the engineering department. So I signed up for that. All the reviews said it was extremely difficult. And when I took the course, it was difficult. It was all about option pricing, swap pricing, with all the calculus, the Brownian motion, the physics, everything involved. And in that class, it was taught by a professor named Vadim Linetsky. I go up to him after class, maybe it was an exam one day, and I said, this is interesting, but could you make money with it? And he said, oh, yeah. Yeah, he said, oh, yeah, you can make money with it. Let me introduce you to a firm. And he sent me an email about a firm in Chicago called Peak Six, and they were having an open house. And I thought I'd just go check it out. I didn't know anything about trading. And I went there and I saw what they did, and I was blown away. I wanted that job badly.
First of all, right when you walk into the office, you're blown away. For anyone, anyone who's listening, go Google Peak Six office and look at that trading floor. It's the old, where the first Board of trading pit was, the old ComEd, was it? Or whatever that name of that pit was.
right there, looking down LaSalle Street. Pretty cool.
Yeah, it was great, and the people were great too. On top of it, and we have some mutual friends that are there. Some great people I interviewed with. I shadowed a trader for a little bit on the desk. And that was my first foray into options trading, real options trading,
Really? So
and
you were just total newbie, said,
total
knocked on the
newbie.
door.
Yeah, and since then, the rest is history. I've been in the business ever since then.
I think talk a little bit about that. I think the perception would be at a firm like that, you need to come right in and have the experience and be able to get a P&L going right away. And if not, they'll cut bait, right? Were you like
Um,
given capital to trade right away?
oh no, they have in firms like that, a lot of them, the Susquehannas of the world,
Hmm.
Optivers, IMCs, they all have training programs where people come in that are hungry, that are smart, and they train them. So they train them on options theory. They might do some mock trading. They shadow traders. You're possibly part of a team, learning what they do. And then also, as you learn, over 6 months or a year, you're providing trading ideas and getting feedback back and forth the whole time. Um, when I started there, I was part of a group trading leap options, and um, it was a great group and learned so much about that, why it's different from trading other types of options, listed options, and single stocks. Um, but you're definitely not given a book right away. You have to learn, and then eventually you could graduate. You're part of a trader assistant class. You graduate, and maybe you're given a small book, and they see how you do. You're kind of on your own, and that's really the most exciting part. You
Yeah.
really feel like at that point you have your own portfolio. You're almost building your own business inside of business in a way, and managing your own risk, putting on trades yourself. Nobody's approving, nobody's disapproving. It's kind of sink or swim.
Really?
Yeah, so it
But
was a great feeling, and you don't need to make money right away. Just there's different times in the market. There's different opportunities. So it might not be a great opportunity set for you. So it just depends, like how are you trading? How are you navigating that? How are you protecting capital? How are you managing risk? So there's all of that involved. It's
is
not
it,
just make
that seems
money
like a
right away.
quick way out of the program, right? If you're like, oh, that's not a good opportunity set, I'm going to force it, or I'm going to go
Oh
into these
yeah.
things I don't know how to do.
Yeah.
Um, and talk, so had you got an electrical engineering degree?
Yeah. I got an electrical engineering degree.
Yeah.
It was a focus on wireless communications, actually. So
So
a lot of math, but that did help me when I was working. All of that math, all those statistics, all the probabilities, thinking like that, because options pricings are based on probabilities. It's based on Brownian motion. If anybody knows anything about Brownian motion, it's where you drop. It was a physicist. You drop a oil, drop of oil into water and see how it moves, and you can model that. And that's kind of how stocks are modeled. How do they move? How volatile are they? How the dispersion of it. Um, so I used that in the option pricing when I was at the firm.
and what other, either at that firm or in your experience with
Mm-hmm.
other option traders, right? There's not a lot of people that just go to school specifically to learn financial engineering and become option traders, right? It's like this guy was a former poker player and this guy was an electrical engineer. And like talk a little bit about that, of like some of the wide career paths that got them into prop shops like that.
I mean, I know people who had philosophy majors
Yeah.
that
Yeah.
that started
Guilty.
for
Yeah.
yeah. There you go. That have become great traders. People who studied accounting. But all those diverse views kind of helps build a firm in the way people think. The poker players thought in a different way, and actually they're very accurate on how they place their bets, the sizing of the bets, and the risk management. Are they getting pot odds, for example, um, and how much to bet on that versus the risk versus the reward. Um,
I love
and
it.
they're great. I think it was in the 20 teens when poker was banned in the United States. So I think there was an influx of professional poker players into trading
Yeah, it
back
was like
then.
the Black Monday of poker. I think like they
Yeah,
made that ruling and they called it their own Black Monday. I don't
exactly.
know if it was a Monday, but it's one of those.
And some of those people, they went to firms like, uh, Chicago prop trading firms, firms in New York. And I know a few, they've become great traders and they had no background in trading, no background in options, but they learned and they were hungry and they succeeded. Some of them became more algorithmic, um, more automated, but some are still very discretionary um, and very profitable. So all these diverse view sets, I think, help build a firm. That way you don't get everybody looking at something the exact same way.
Yeah. But that's confusing to outside looking in also like are you being taught a way to do things? And hey, here's how we make money. Hit this red button when this clock hits 12 and do this. Or they're like, hey, you know how to think. Here's the playground and see what you can do inside of the playground here.
It's definitely the latter. And I tell people there's a science to it. There's the math behind it. But then when you're actually trading it, it's an art form. And anybody could learn how to paint. But there are some, master artists out there. And I think it's the same thing with trading, and especially discretionary options trading. There are some people that are just fantastic. They're artists, they're talented. And it's like I think about basketball a lot when I think about this. What did Michael Jordan have that some of the other basketball players didn't have? And it's hard to point to something exactly. Was it grit? Well, a lot of people have grit. The desire to win. Well, a lot of people have the desire to win. Why was he better? And he just was. And it's
Yeah.
the same
Well,
thing with a lot of traders. Some traders just have it. They're master artists. They master their craft.
nature
And
versus nurture. You have to have it naturally. And then we can also bring it along with some nurturing. But
right,
yeah.
right. And I still, to this day, I still don't know what it is. I can't point to something that says this is why this person's better than another person. I can't point to it. And as a trader, I knew some traders were better than me. There was a lot of traders better than me, but I couldn't really figure out why. Um, Maybe they had a better risk tolerance for holding their winners. Maybe they cut their losers short earlier. I don't know what it was. But there are traders that are just better than others.
Hmm. And then one of my favorite stories is it's like a market making day where you're making markets on like, can Gary throw this ping pong ball 50 feet to the wall on the other side, right? And all the traders and interns and everyone would be trying to make a market on that. So kind of teach you how to think in probabilities and
Oh yeah.
any of
There's
those
some.
stories you can share.
Oh yeah. We had a game. I don't know who introduced it. I think it was my buddy Clayton, who I traded with, called the Almanac game. He would
Hmm.
just flip through the almanac and say, "All right, make a market on how many miles to the moon." And traders would start trading it. Um, Sometimes, and we get creative. They start trading the options on it. They would start trading this, and it would be like a trading pit. And we would do this probably a couple times a week, and it was a lot of fun. Um, we would also, trade on. There was a basketball hoop in
Now
the
we got, I think
office.
it's about 350,000. I'll make my market at 300,000 miles.
You know, let, let's
Google it.
three
There's the
hundred thousand to
other,
what?
yeah, there's the other, how many times you have to fold a piece of paper to reach the moon, which I think is like, the answer is like 64 or something. Like you couldn't physically
Oh,
do it actually, but right,
yeah,
because, and that teaches you like non-linearity, right? It's doubling, then the
right.
double doubles and right, you get halfway there and that last fold is the one that gets you all the way to the moon.
Right. So the answer, miles to the moon, 238,000. So you're pretty
Ooh,
close.
all right.
Yeah,
There you
but
go.
there'd be two-way markets and people would be buying and selling and tightening it up. And it taught you a lot about trading.
So that
doing
wasn't
that.
an official thing. This is just you guys bored on a Tuesday and the market's
Oh
not
yeah,
doing much and like, okay, let's figure out what we're doing.
yeah, and I think maybe firms started doing it as part of a formal training,
Yeah.
but it was just fun for us.
And so talk a little bit, you have all these diverse people, they're becoming great traders, and this will feed into what you guys are doing at Zero Delta, but how do they, some will naturally be like, I'm so good, I want to leave and go hang my own shingle, do my own thing, versus some are drinking the Kool-Aid or whatever it is, or they get compensated very well. They're like, hey, stay here making the firm money. Like, how does that balance work out?
Yeah,
Generally, yeah.
I think it's not so much that traders think they're so good that they could leave. I think it's more of a mindset that they want to build something on their own. Um, and I think there's just two camps. There's people who want to do that, and then there's people who just don't. And some of the best traders that I've seen just stay at the prop firm, whatever prop firm it is, forever. Um, and they like it. It's just a mindset. Some other people just have a mindset, I want to build something on my own. Maybe they have a mindset, they want to build something big. They want to be the next big prop shop, big market making firm. They spin out of Optiver, they create a Kuna, they have visions of something large. Some other people just want to spin out, have a small 2 to 5 person firm and make money for themselves and family and friends. Um, I think it's just a mindset. Um,
So
some
in some
people,
cases, they might be like, hey, I know I'm going to make less money,
yeah,
but I want to be my own boss. I want to have my name on the door or whatever.
absolutely,
Yeah.
absolutely. And there's some people that are more reliant on technology at a lot of these prop firms.
And
And there's
like,
some people that aren't. So they feel more beholden that they have to stay.
right. Or it would cost them $2 million
Yeah.
a year to have the technology in place or something like that.
Yeah, they need to build it out. It'd be a large build out. It won't be as good. It's actually pretty surprising. The technology at these firms is state of the art. It's really good at all these firms, whether it's Wolverine, Susquehanna, Peak Six, jump trading, whatever it is. It's all really good, and you don't really know how good it is until you're in there and you're like, wow, um, it's much better than the big banks.
And that
Um,
you think that gives an edge just in terms of speed or in terms of pricing, all the above.
all of the above. It's
Yeah.
an edge. It's a big edge.
But it's not what we were talking about back in the day of like high frequency trading and satellite dish relays for quotes and all that stuff.
Yeah, some firms still have that.
Yeah.
And the co-location, the cost of all of that is enormous. Costs of some of these firms are hundreds of millions of dollars a year um, for all the servers, all the connections, all the microwave frequencies, whatever it is.
Yeah.
So
Yeah, microwave towers, not
yeah,
satellite towers, but maybe they were doing
yeah,
satellites too.
yeah.
The
The satellites were slower, or something with weather. But even the microwave towers, you had to measure wind speeds because the towers would shake.
wow.
um, yeah,
Why
yeah,
is my quote off a millisecond? But
right.
generally, peak six and right, I know some about that. They're not doing high frequency trading. They're not really doing market making. Some shades of
I,
it.
I don't know. I haven't been there in
Yeah,
8 years. Maybe they are now. But they're quite a sophisticated firm that can adapt to any market. There's very smart people there,
yeah.
and
All of it,
it,
and then it also, and then we'll get. I think there's smart people at all these places. How come they don't just cannibalize each other? Right? Isn't it zero sum? And they're like all the Susquehanna traders are battling against the Peak Six traders are battling against Jane's trader. Right? It
yeah,
seems like
yeah,
it's zero sum. So who's getting taken advantage of for all these firms to be so successful?
yeah. At some point, you think it's robot versus robot, professional
Right.
versus professional, and at times when it's slow, when there's not a lot of volume, I believe that is the case, and you'll see it in the P&L. Um, but at other times, it becomes active, and I think it's been a lot different in the past 5 years or 4 years. The proliferation of retail trading options has exploded. The proliferation of these ETFs that are created that trade options, whether it's on the indices like JEPI or even single stock ETFs that are overwriting calls. I think there's a bunch there. I think Yield Max has a bunch. These have quite a lot of AUM. I think over 200 billion of AUM in all of these and growing fast. So I think now there's just a lot more diverse players. There's also a lot more products. There's a lot of retail and zero DTE and quite sophisticated retail, I would say. So I would say before probably like 2011 through 2015, 2016, maybe it was a little bit of that professional versus professional, but now I think there's just so many more diverse players. There's big institutions getting into options. I remember when I started back in 2006, somebody from a very large hedge fund in New York was talking to me, and they were long short equity fund, billion-dollar positions, multi-billion-dollar positions in names. They never traded a single option ever.
Wow.
So you ask them, what do you think stock's going to do in the next, 3 months? He's like, it's going to be in this range. And you look at the straddle and like, well, that straddle's a sale.
Yeah.
And he's like, well, what do you mean? And you're like, well, you have a position. You should sell like 5,000 of these straddles. And so back then, even large hedge funds had no idea about options. But even recently, I think everybody knows, SoftBank got into options in a big way in 2020 and 2021. They're buying a lot of upside options in big cap tech. So that's just another player. And I think there's going to be more and more diverse players in the options market. So it's not going to be professional versus professional. There's going to be people doing things for different reasons, whether they're overwriting, whether they're speculating, and they're big.
And so back to our poker talk, like the poker analogy is you have the 6 pros, 5 pros are at the table on a Tuesday night in Atlantic City. There's no other guests. They're just they're going to go back and forth and basically be flat. Now a couple tourists come in and maybe a big spender corporate guy comes in and like, okay, now we've got some new money in the game that we can trade around and get around.
Yeah, and not everybody's trading vol, for example. Some people are overwriting, so they just want that yield. So they're not very vol sensitive. So that provides opportunity. There's people that are speculating, just buying options. So they're a little bit more price sensitive, but they're not vol sensitive.
Yeah.
So they might say an option's $1, but you're like, wow, that vol is high. But they're like, it's $1. It's it's cheap for what I think the stock could do. So it's for different reasons, and then people are hedging it with the stock. So yes, there is a little bit of a zero-sum game, but it's so intertwined with so many players. You're trading the stock, you're trading the option. This person's trading vol, this person's trading direction. That there could be a lot of winners at the same time.
Would a simplistic model be like JEPI? And what we're saying, JEPY, I think is the signal, right? They're selling calls against the S&P essentially.
Yeah, they're selling calls.
So would it be fair to say like that strategy in a vacuum would return more, maybe 1% more a year or something, or 50 bips a year more, and like the prop firms are kind of earning that extra 50 bips by providing the supply to firms like JEPI? Total simplistic view, but
so JEPI, so let's say JEPI sells that call, right? And over time, stock goes up, but that call expires worthless, right? So JEPI, they made money on the call, they made money on the stock. But if let's say you're the prop firm, you buy that call, you think it's a cheap vol, maybe it realized the vol over time, and you're dynamic hedging, you're doing different things. You could win also on that side if they sold the vol too cheap. So who's losing? Well, maybe the people trading the stock are losing because you're gamma scalping back and forth. The other people on the other side are negatively scalping themselves. So it just depends. There's a lot going on. I don't think it's just one person versus another. It's just it's just so intertwined.
It's a podcast. We're trying to simplify it to five boogeymen. Let's get into Zero Delta. How you started it, why you started it, what's going on behind the scenes, wherever you want to start there. Go for it.
Yeah, I left trading in 2016 and took a year off and was trying to figure out what I wanted to do. Did I want to continue to trade? Um, but my passion was always investing my own money. I always loved to do that. And I wanted to invest in a strategy that was absolute return in nature, but typically did well during market volatility. And I mean really well. And I didn't know anything like that except trading volatility. So I was just investing my own money uh, in some vol traders that I knew. A lot of these traders that had these strategies were typically capacity constrained. So a lot of institutional allocators just overlooked them. A pension might need to allocate $300 million in a shot, and somebody trading some of these strategies could only handle maybe 50 million or 100 million. So they didn't bother. But also the strategies were pretty complicated for just high net worth RIAs. So
It's
they
like
overlooked
stuck
it.
in this weird spot.
Yeah, stuck in this weird spot where, maybe the trader has some of their own money or a lot of their own money and family and friends money. Maybe they have 20 million. And for a hedge fund, a lot of people say you can't run a hedge fund at 20 million. Well, oh, yeah, you can. You could be lean and run hedge funds at that size. Because if you have good returns, you're making a good living. So I would try and seek out hedge funds like that, where people have strong options pedigree and they're trading a lot of their own money. And they have the same risk philosophy as I do. When there's nothing to do nothing, preserve the capital, and then when there's something to do, pounce. Um, and I was doing well. My partner Chris joined after he left prop firm, and he was investing his own money as well. He's been investing in hedge funds since the 90s. So we decided, maybe we should just launch something where we could get an audited track record and family and friends could come along and anybody else. So we created this entity, Zero Delta Funds, in May of 2021, and we've been running it ever since. We launched it with just our own money. We weren't really looking at that point to raise big capital. All the time I'm seeing, trader from Citadel leaves, launches new fund with 750 million. That wasn't our idea. Our idea was to launch our own money.
Those are always great articles.
Yeah. Yeah, produce good risk adjusted returns for ourselves. And if other people want to come in, great. So that's what we did.
But the concept is like you're back. Say you could put all the traders at all the prop firms in one room, and you're sitting there at that desk, and you're like, "Oh, I like what this guy's doing. I like what this guy's doing. I like what that guy's doing," and kind of picking them out in that manner. And they've already left the prop firm, so you can't. Which maybe we should clear this up for some people. Like you can't, as an investor, put money into the prop firm for someone or for the prop firm to trade. They're trading their own money. That's it.
Yeah.
They don't want outside money.
Yeah, and we don't even ask those traders to come out. It's really, we talk to people who have already left, because then they have the mindset that they want to leave already and they want to start something on their own. We don't want to convince anybody.
Yeah.
That's part of our due diligence process is, do they have the confidence and the will to do something on their own already? So we won't even talk to somebody who's already at a prop firm.
Yeah.
They have to already have left, want to start this with their own money and get going. We don't make any assurances. And that's part of the due diligence process for us, is their mindset.
And beyond their mindset, what are you looking at? Okay, you trade these types of options. I know that. Tell me about the strategy.
Yeah, definitely tell me about the strategy. What do you trade? We try to assess the risk. We try to assess the risk philosophy also. We also try to pick traders that have a single specialty. And there's a lot of people that say we trade options. So they might trade dispersion. They might trade just single stock relative value equity vol. They might trade a tail strategy. But if they try to do all of those things at once, they're not a specialist. So we try to pick people who are specialists. So for example, we might have just a vol dispersion specialist. We might also have just a tail hedge specialist. Then we might have just a zero DTE specialist. All they do is zero DTE. And that's kind of how we look for groups. specialists because they focus on one thing, and then they typically don't have strategy drift where they try to do something else and we don't know about it because we're LP investors. We're not managed account investors.
Yeah.
So that's a big deal for us. And we've actually avoided strategy drift by picking specialists.
And then you want them to have skin in the game and have made enough money elsewhere where they don't feel the pressure to press to do something during a flat period.
Yeah, but not necessarily. So we're a little bit different. We tell people that we don't mind paying management fee because it keeps the traders patient. Which I think a lot of traders, if they're not earning some sort of fees, could get a little impatient. Also, they don't necessarily have to be very wealthy. So, for example, we've invested in traders where they're very young. Maybe they traded for 5 years. Maybe they have maybe only 500,000. But the point is, they put all that 500,000 in their fund when they start, 100% of their net worth. So they're all in, and that's very comforting for us as well, where they believe in themselves so much and their family. Even, who else is putting in? Are your brothers? Are your parents? That gives us a lot of comfort as well.
We kind of, as an industry, as a group, interchangeably say options traders, vol traders.
Yeah.
Like how do you view the difference?
Yeah.
I feel like if we were having this talk 10 years ago, we would have been talking only as option traders. Right
Yeah.
now we talk about vol traders. So what's the difference in your mind, if there is one?
There is. An option trader could be, vol traders are options traders. Okay, but not all options traders are vol traders. So somebody who's a vol trader is looking at the actual vol and saying this vol is too cheap or this vol is too expensive for whatever reason. And they're actually trying to isolate that vol and capture that vol. An options trader could be looking at different things. They could be looking at, a premium capture strategy, a tail strategy. So for example, like zero DTE, you could say I have a premise that there's a vol risk premium, but also maybe the index tends to trend during the day, or I'm looking at the bid-ask spread expanding or collapsing throughout the day. So they're not really looking at vol at all. They're looking at different metrics. They're looking, how far away is it from spot to hedge out all my risk, and how does that change over time? So they're not looking at vol, but they're looking at prices.
Or just like a simple bull call spread or something like that.
Yeah,
Just
exactly.
Putting on
Looking at that, looking at different structures, broken wing butterflies, and why does that work? Time spreads. How do I increase my vega, reduce my theta? So if there's a vol pop, I don't get killed on the move, but I could benefit from a vol pop. Different things like that.
And vol cheap, let's use everyone's favorite stock these days, NVIDIA, right? So I don't even know what it's probably like. My guess would be it's like a 40 vol or something, or 60.
Yeah, I don't even know, but I think maybe a 40-ish.
Let's call it, right? So when you're saying guys want to trade the vol or they think vol's cheap, let's use NVIDIA. It's got a 40 vol, which means, right, you can do the math on that of what that means for annual movement. But probably, what does that mean? 120% annual movement or something? 16 times 4, 40, 240%?
It depends on how you hedge it, but in general, 40 vol would mean like a 2% move every day.
Yeah. So they're saying, hey, this is too, I went the other way. 40 divided by 16-ish, right? So this vol trader, theoretical vol trader, saying this thing is trading like a tech stock in 99, like 2% a day is way too small, which it seems like that would be, right? So that's a vol trader saying, I don't care really what the business case is, what anything is. I'm just looking at this versus the probability that it would be more volatile in the future.
Exactly. And you price vol based on the past, right? Like that's how you predict, what did it do in the past? But a smart vol trader will say, well, this environment, for example, semiconductors is a different environment than 3 years ago. or 5 years ago. Something has changed. Now, does that mean these should be more volatile or less volatile? Well, you can make an easy argument that more volatile, right? Especially on what these stocks are doing right now. Even when you look at a name like, a few years ago, there was Disney, and Disney didn't have streaming, and they wanted to get into Disney Plus. And you could look at that and like, Disney's a 20 vol name, but if they want to get into streaming, who are the streamers? Netflix. Well, Netflix is like a 40 vol name. So should Disney be a 20 vol name in the future? Well, maybe it should be like a 23 vol name. But then also you get new catalysts. They're going to release Disney Plus subscriber growth numbers. They're going to release it on this date, so you get new catalysts. So pricing all of these little things into what you're doing gives you an edge. And I think a lot of these traders are looking for different kinds of edges, whether it's a macro edge or an event edge, or they're trading something called skew. So that's like the downside options versus the upside options, different things like that.
And then you've uncovered a few guys who what were we talking about yesterday? You were asking them how they priced the vol, and they're like, I don't price the vol, or what was it, Vega versus. Tell me, I like that story. Tell me that story.
We were with one group, and we asked them, do you break down your vol P&L versus your gamma and your theta P&L? And they said no. And then I was just thinking, well, it's kind of hard to figure out if you're making money on vol if you don't do that. So then another time I was in France, and we found a trader. He was just in an office by himself trading 15 million euros, and I asked him, so the same question, do you break down your vol P&L versus your gamma and your theta? And he looked at me almost angry but kind of confused. He said, of course I do. How else do you trade vol? And I was like, I love this guy.
You're hired.
Right. So we asked them nuanced questions like that, just very simple, and just to hear their answer and evaluate whether or not we think they're the real deal or not.
Right. If they're truly sophisticated, or whether they've just kind of stumbled upon something.
Right.
And so you'll travel, you'll fly to France and meet with a trader. You'll go wherever the trader is.
Yeah, we're a little bit of a different kind of fund of funds, in the sense that we typically don't invest in the large, well-known managers. We're really looking for managers that don't have marketing material, under the radar, don't go to conferences. So we're kind of like, I'm sure you've seen or read the book Moneyball.
Yeah,
we're the ones going to the Dominican Republic, the Venezuela, the Japan, South Korea. Those are for baseball players, but we're going to places that are not typical to find options traders. We're going to France. Now, France has a very good derivatives background from the French banks. We're going to Amsterdam. Amsterdam has a lot of option prop traders. We're going to Asia, different places there, to find people trading different things. We're going all over the place to find traders, and we find them through our trader network. We're also very active on LinkedIn, finding people who have previously traded at a big firm and just see what they're doing now, if they're doing something different, and messaging them. So we're pretty aggressive in that manner.
Love it. And how many are in the portfolio now?
Right now we constructed a 8-manager portfolio. I'd never see it being more than 12. There's some in the bullpen that trade a little bit differently than what we're typically used to. So we're doing diligence on a few, but there's 8 right now.
And do you have preconceived, would you be like, I have 10 vol dispersion traders and 2 tail risk traders? Or are you trying to balance that?
No, we
try to that exposures out.
Yeah, we try to balance it a little bit. Just because if vol dispersion is not good for a period of time, we want to make money in other vol strategies. So we try to spread it out a little bit. Now, saying that, if we find another good vol dispersion manager, we'll just add it to the portfolio, but we'll have to determine the sizing of that.
And then what have you seen from looking inside or getting these guys monthly reports or talking with them of like, where are we at in terms of vault, right? VIX as a crude measure has gotten pretty low. The inside dispersion has gotten very high, right? The NVIDIAs and things we're talking about
Yeah.
are moving like crazy, but the index isn't really moving. So
Yeah,
like, what's
right.
your thought on what you're hearing from these guys?
Right now, what I'm hearing is that it is still a tricky market. It has been, but there's becoming a little bit more opportunities. And there's opportunities when stocks go, right? Like some stocks are going, these semiconductors are gone. Uh, if you've been following any of these pharmaceutical with like the Ozempic and the diabetes weight loss drugs, those have been going too. So there, when stocks move a lot, there's going to be some opportunities. If you take out some of these big, large cap names out of the S&P and you look at all the rest of the names, all the rest of the names might be more correlated to like a Russell 2000 index. So like just looking at different ways to trade these could provide some opportunities. So I would say opportunity set is better than it was 6 months ago or a year ago. It's still okay, but one thing I would say is with vol, you can never time when it's going to get good. It gets good in a flash, and you don't know how long it's going to stay good. So that's kind of why I tell people if you're in relative value vol, you kind of always have to be in it. You cannot time it. You cannot say, I think something's coming on the horizon. You might wait 3 years
Yeah.
for that.
Right. You could say NVIDIA's vol is cheap or expensive. It could keep doing that for years and years.
It could, yeah, yeah. NVIDIA, and then it could die on you.
Yeah.
Also, you could look at it's cheap now, but the vol could die, and you have to determine, okay, I'm paying a 40, where could, or whatever it is, where could vol go? Versus, you said VIX is low. A lot of option vols are low as well. But now, so in the risk reward, if you're buying vol, maybe it can't go much lower, you think. So you're getting good risk reward. If something does happen, you could get a very big pop. And this is exactly what happened in 2019 going into 2020. 2019 was a very low vol year. And then at the beginning of 2020, if you had a thesis that this COVID might become a thing, in January, some
Yeah.
people were thinking that, you could say, okay, vol's up very slightly. But if you put on this trade, very long vol trade in single stocks, my risk is, okay, I might lose a point or two, but I think I have a lot of upside where it could be generational wealth created. So and I think that was very different from 2022. Now, a lot of people said, going into 2022, I think, there's going to be a market correction. But vol was coming from a high place. So even
Yeah.
if you thought that and you bought vol, you were not rewarded.
Yeah. We talked about that the other day. The
Yeah.
3,400 put, I think it was, if you bought it at the beginning of the year, market goes down 20%. It was at the same price at
Yeah.
the end of the year.
Yeah. It's great for a vol seller, right?
Yeah.
So, so it just depends on where vol is coming from and your thesis. So pricing dictates a lot. It reminded me a lot of 2011 with the European debt crisis. Vol was still kind of high from the great financial crisis. So when you bought vol, and even though the banks moved, you weren't really rewarded that much. It was very similar. So all it depends on where vol is and where you think it's going. So right now, vol is in a kind of a low place.
Yeah. I went to a talk once and the guy questioned the audience. He's like, if you had a time machine, you went back to the start of the tech bubble, what trade would you put on to make the most money? And he like the statistics showed selling puts was
Okay.
actually right. A lot of everyone's like buy the out of the money puts, but
Yeah.
selling the monthly puts was actually the highest return over that period because the vol just got so high,
Yeah.
which was
I
always
know it.
been interesting to me.
I know a trader that was short vol all throughout the great financial crisis and made more money than a lot of the people that were long vol. And
Yeah.
that's a lot of it's because of the names you pick.
Mm-hmm.
If you're selling SAP vol, when it's high, or Target vol, Target got to 100. Are those companies really affected that much? as much as some of the financial companies were affected. No, but they're
Yeah.
trading at a higher vol.
Hmm.
So it just depends on what names you're picking. A lot of
Right.
times,
Some of
and I
that
think
structural of like a firm selling the whole basket of stocks and it's
yeah,
yeah,
yeah, structural. It could be somebody.
puking out.
It might have been Bill Ackman who was buying target options. And I guess he wasn't a very sophisticated vol person because I think it was more on
Yeah.
price.
Talk a little bit about the difference, right? A lot of the vol guests that come on here are trading S&P futures,
Yeah,
SPX options, VIX futures, VIX options, like basically all a lot of in just the index box.
yeah,
So we've talked a lot about single name
yeah.
vol. Like, do you view single name as essential to be part of the vol toolbox?
Yes, I definitely do. Part of the reason is because if you're trading just a few indices, if you're wrong, it's it's hard to make it back. In single stock options, you could have a very broad portfolio and be wrong on a few, and you have a whole book working for you. There's just a lot more opportunities. Just
But doesn't it also get too big, right? If you're doing a classic, just if you had to be trading all 500 names, the S&P
yeah,
versus the index, that can get expensive.
yeah, yeah. So a lot of people don't. They might trade 50 names um, in the S&P versus the S&P or versus the Russell. So I think you just have to get creative. But I like the single stocks. They're also more capacity constrained.
Mm-hmm.
Now Nvidia trades a lot of options. You could get big in Nvidia, you could get big in Amazon, Tesla, but in general, you can't get as big as you're trading the S&P or VIX or different things like that. And I think that's why a lot of people gravitate towards those products is they could create a bigger hedge fund with those products with less manpower.
Yeah.
When you're trading single stocks, it's manpower, it's technology, and it's capacity constrained. It's not very conducive to if you want to build a large hedge fund.
And talk through that a little bit. Like that's why these prop firms don't become $800 billion
Yeah,
behemoths.
exactly. They can only deploy a certain amount of capital in single stock equity options.
Which is
Um,
what's that power curve look like? There's like 15 names, 50 names.
in single stock or
Like
firms.
no, in single stock names that like Peak Six or some of Susquehanna can actually get their size off in.
Uh, Maybe 50 names
Yeah.
or 100 is more now, I think, than it was. You could get a little bit bigger now. You have to be more sophisticated getting in and out
Yeah.
than you used to. The market makers are quite sophisticated. Um, yeah, so there's more names, but there's also a lot of names where there's a lot of edge that are more thinly traded. And if you know how to inventory that risk, you could do quite well in some non-liquid names as well.
Um, yeah, I remember a story of one guy that they had this guy was trading all those illiquid stuff. He went on vacation and his bids and offers weren't getting reflected in the pricing anymore. And the pricing like blew out huge on the bid ask
Yeah,
and they were pricing it off the offer, I think, and like the whole book looked terrible. And he's like, relax, it's just because I haven't put my quotes in there.
yeah, yeah. The book could get very marky on those names.
Yeah.
So you kind of have to know, this is where I go back to. You have to know where the P&L is coming from all the time. Is it coming because you're actually losing, like you're short vol and the stock is actually moving? Or is it just a mark? Or are you making on the actual vol? That's why I get back to breaking down the positions is very important.
Love it. What else we got to cover? So you got a website. How do people get in touch with you?
Yeah, we have a simple website, zerodeltafunds.com. We're an open book. There's no secrets over here in what we're doing. People know uh, vol trading, but I think a little bit of the difference in our firm is our approach to finding managers, the groups that are under the radar, the groups that I think are some of these traders are so talented and larger firms like the Millenniums and Citadels and Balyasny's of the world want them, but they just have the mindset that they want to compound their money, family and friend money, um, and run their own small firm on their own. And those are the firms that we find the best talent. So yeah, so zerodeltafunds.com. You could just email us right on the form there.
And then the name, but you're not actually Zero Delta all the time. Or are
Not
you? Yeah.
we try to be.
Yeah.
I'd say the managers have some flexibility on how they hedge their deltas, but the name kind of came from there's two things. First, it was a joke. We would first we would say, what's the delta of this happening? And we would always say, oh, there's zero delta of that happening. What's the delta of us getting this business off the ground? Oh, zero delta. Oh, let's just name it zero delta.
Yeah.
But also our portfolio, we try to have no directional risk in our portfolio. Sometimes there is because you pick up deltas from gamma, but we try to have it flat.
That's a very Chicago trader community thing of just like, what are the odds that it doesn't rain for the Cubs, right? People be like, I give it a 10 delta. We actually get to this Cubs game and it doesn't rain, or like the guy's drinking at the bar. I give it a 80 delta. That guy falls off his stool.
Exactly.
Like, that's common
it's a
language.
Chicago language. Definitely Chicago trader language.
And last piece we didn't hit on, I think they're trying to be zero delta, but you're also trying to be positive skew or long convexity at the end of the day, right?
That is definitely what we're trying to do.
Yeah.
We follow the Pareto principle. I think 80% of the money is made 20% of the time. I actually think it might be more like 90-10. Those periods are very lucrative, and you have to be in the game. You have to have dry powder to really capitalize on it. I would say we look for managers more with a long vol bias. That doesn't mean they need to be long vol all the time. So for a good example that I went back to before was SoftBank. They pushed Amazon vol up into the 60s. Now you can't be long a book when some of these names are trading on ridiculously high levels, but you're protected a lot. Amazon needs to move more than 3% a day over a sustained period of time for you to lose on that. So they try to, but at times they might be shortfall, but we're always protected on the tails, I would say.
Yeah, which is perfect, right? And if you can carry flat-ish, right? Slightly positive, and then have those pops, that's the ideal.
Yeah, we try to. In single stock equity options, there's opportunities at different time. So we try to have, the upper single digits, low double digits returns, but then really, really have high returns when in quick risk off events, the COVIDs, great financial crisis, .com bubble and bust. Even times like August 2015 when China devalued, or taper tantrum in 2018, or Volmageddon. You make a lot of money during those periods if you know what you're doing.
What do you think? This is totally out of left field, not what you do, but right, you don't really care what is the next catalyst, but do you have any guesses what the next catalyst might be?
No idea. And I think that's no idea. And I think that's the best part about vol trading is it typically comes out of left field.
Right, or else it's already priced in, like if it's a known.
Yeah, so always out of left field. Like India moved 8% last week one day.
Yeah. Euro stocks was down 3%. So there's political stuff happening over there.
Yeah, there's a lot of political things in the world. I don't know if it's going to be a war. I don't know what it's going to be. But
my guess is some huge Home Depot or someone comes out and says like, well, we're pulling back on our AI spend. We don't think it's all that good. And then another one, and all of a sudden, Nvidia's cut in half.
Yeah, it could be a big catalyst like that. It could also be something tied to interest rates and inflation and our deficit where people haven't cared, but then they start to care.
Yeah.
And that, I feel like that they're navigating a cruise ship in a small canal. That's going to be a tough one to turn around. Now everybody knows it's there, but nobody knows when people are going to care. So that could be the canary in the coal mine here.
I like it. And again, that's not what either of us do. So it doesn't matter what we think, but it's fun to speculate.
Right. But you still need to, in the back of your mind, always be aware of these things. and position your portfolio for what you don't know as well. And also recognize that you don't know everything. The best traders are the ones that know that they don't know. They don't have an axe and try and fight the market. You try and fight the market, typically, it won't end well for you. So being flexible, going with the flow, trading what's in front of you, having your thesis, having your risk rewards, that's the name of the game, and protecting capital.
I love it. Can't say it any better than that. All right. Thanks so much, Gary.
Thanks,
Safe
Jeff.
travels back to Miami. It's like, what's going on? It's flooding and raining down there.
Yeah, we had no rain for 6 months, and now it's all coming in 1 week.
Yeah.
So, yeah, 10
right.
Delta, I get back to the airport tonight, by the
way. There you go. All right. Thanks so much.
Great.
We'll talk to you soon.
Thanks. Take care.
Okay, that's it for the pod. Thanks to Gary and Zero Delta. Thanks to Jeff Berger for producing. We'll be off next week for the 4th of July and have something for you after that. Peace.
You've been listening to The Derivative. Links from this episode will be in the episode description of this channel. Follow us on Twitter at RCMAlts and visit our website to read our blog or subscribe to our newsletter at rcmalts.com. If you liked our show, introduce a friend and show them how to subscribe. And be sure to leave comments. We'd love to hear from you. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of RCM Alternatives, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations nor reference past or potential profits, and listeners are reminded that managed futures, commodity trading, and other alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors.